Hi everyone, Professor Lee here, and today I want to talk about a very important question that many of you are trying to answer. Do I want to put my money in a traditional account or a Roth account, whether it's 401k or IRA? That's the question. Which one is better for me? I want to address some common misconceptions because a lot of the financial services industry will push Roth so hard. There are times when that's not the best option for people, but there's also reasons why they want to do Roth anyway, and there's psychological reasons. So in this video, I'm going to talk about those things, those common misconceptions, and hopefully by the end you can make an informed decision for yourself as to which account you'd like to use. So first misconception I see all the time: you want to pay tax on the seed or the harvest? Okay, people kind of pose that question. It's kind of a misleading question because who doesn't want to pay on a tax on a smaller amount versus a big harvest, right? So it's a bit misleading because the calculation is all based on the cumulative principle, right? Really, if you have the same rate of return and the same tax rate, both now and in retirement, you'll have the exact same amount in the end. So the seed, paying on the seed or the harvest would be the exact same amount if those are equal. If the tax rate is different, then it's different, obviously. But if it's the same, it doesn't matter. For example, you have $10,000 investment at 5% return over 10 years in a traditional account where you're paying taxes later. You accumulate $16,289, but then you have to pay that 20% tax on it. So you end up with $13,031. Well, what if you're doing it in a Roth where you're paying taxes now? So instead of having $10,000 to invest, you only have $8,000 because you paid 20% tax now. Okay, the tax rate's the same. But then the future value, that $8,000 grows 5%, 10 years, and you end up with $13,031. You end up with the exact same amount, assuming the rate of return is the same and the tax rate the same. Okay, the one thing you want to consider is my tax rate going to be higher or lower in retirement? And this question is hard to say, right? But we can estimate kind of, okay, based on inflation adjusted returns and everything else and inflation adjusted tax rate, this is about where how much income I'll have in retirement. It's impossible to tell what the tax rate will be, but we can get estimates of, okay, if the tax rate goes up, this is where we'll be, etc. And that helps with your Roth versus traditional decision. Let's look at an example before we look at the next misconception to show you how this cumulative property works. Okay, so we have a 50-year-old and married, filing jointly, making $150,000. So there's a couple here, okay, but maybe only one of them is making money, $150,000. So they'll be paying $35,132 in tax and have disposable after-tax cash of $114,868. Let's first assume that they're doing all Roth and they're maxing out their Roth 401k. They're saying, okay, we have $23,000 we can put into our retirement. Where you have none right now, we're going to start expediting our retirement savings. Well, if you put it in Roth, how much tax does that save them? No tax, because you don't get that tax deduction. It's with after-tax dollars. So we end up with $23,000 in that account. So I'm going to just copy that and paste that as our first scenario. Well, if they're maxing out that $23,000 until they're 73, just like we're assuming that may be their required minimum distribution age, okay, they would have $1.3 million. Okay, so 23 years, they have $1.3 million. Isn't too bad, right? How does that compare to a traditional account? Well, this is where the people may be making errors where Roth would always come out better. If you just come over and say, instead of putting $23,000 in my Roth 401k, I'm going to put $23,000 in a traditional, and that's all you did, Roth's going to be better every time. You're thinking, why? I put $23,000 both ways. Well, you have to invest the tax savings, okay? So you can see in this scenario, you save $6,248 in tax between federal and state by making that traditional contribution, okay? So it really only cost you $16,752 in cash flows because you put $23,000 in your account and you saved $6,248 in tax that you didn't have to pay. Well, if you stopped there, meaning you just went and spent that tax savings, the benefit isn't there either, because you can see in the retirement projection, look how much money you end up with. The exact same amount, right? We're assuming a 7% rate of return. You end up with $1.3 million, okay? Why would Roth win out every time in this scenario? Well, you still have to pay tax on that tax deferred money. So if you're paying, and in this scenario, they're in the 0.2, about the 27% tax bracket, that's how much tax you're going to pay. So you're left with less than $1 million there because of the tax. Okay. So when you're comparing traditional versus Roth, don't forget to invest the tax savings if you decide to do traditional, because Roth's going to win out every time if you're not investing the tax savings. Okay. So that commutative principle, what we were talking about before, is you put $23,000 into your 401k, it saved you $6,248 in tax. And this is the part where I don't know if most people are investing that tax savings. Hopefully they are putting it in an investment account. What I like to do, or recommend if possible, is throw that in a Roth IRA, especially if you're doing a 401k. And there are income limits, etc. So you'll have to watch those, but put that into a tax-free account. Now I'm diversifying my taxable accounts, okay? Taxable, tax deferred, and tax-free. Now you can see I'm still, after-tax cash flows only decreased by $23,000 because I put $23,000 into the 401k. It decreased my tax liability by $6,248. Then I put that in a Roth, so in the end, it only cost me $23,000 to save $29,000. Okay, so what effect does that have? It's like a 27% return on investment equal to what I saved in tax, right? Well, let's look at our retirement projection. Look how much more money we have in retirement, okay? 1.67 million instead of 1.31 million, okay? But here's the kicker. 1.3 million of that is taxable. We just have an extra Roth account with $357,000. So let's assume if it's that commutative principle again, if it's the same tax rate, I'm just going to delete these for now. But we're going to say, okay, if I'm going to take that amount times 1 minus whatever tax savings I had while I was working, tax rate remained the same. You can see I have $959,306. And now the tax is paid, right? But I also have that additional account. So I'm going to add my Roth account to that. So now I have 1.317 million of tax-free money. They're virtually identical. There's a little bit of rounding there. So again, if the tax rate doesn't change, these are real numbers. We're actually going through the tax forms here. You see it's exactly the same, okay? So when is it different? If you project that you're going to be in a lower tax rate than that 27, whatever your tax savings was throughout those years, if you're going to be in a lower tax rate than that, traditional is going to be where it's at, because you're going to have a bigger balance, and you pay a lower tax on that, you'll have a bigger balance in the end, right? But if you're going to be in a higher bracket, and when I say tax bracket, I also am talking about IRMA, right? The additional Medicare charges as your income goes higher, etc. So those are things to take into account when comparing the tax rates. You consider that a tax as well, and taxable Social Security, etc. So after those considerations, if you're higher, obviously you want to go Roth. But that's not a hard, fast rule. Why is that? Why do I love this third scenario? I love having money in tax deferred. The reason is gosh, when you're older and you have tons and tons of money, depending on how big that balance gets, gosh, what do you want to do with your money? You can give a lot to charity, and there's ways you can use what's called a qualified charitable distribution, where you can give that money straight to a charity, and then it's never taxed, okay? So you got the upfront deduction, it grew to a large amount, and then it's never taxed. So that opportunity, if I just had Roth money, I have this huge balance of tax-free money. I love that, right? But when I start wanting to use these cool strategies where money's never taxed, I lose that opportunity, okay? So you actually limit your freedom if it's all tax-free, okay? The other thing is early retirement. Early retirees can start, so let's say they're not taking Social Security, they could start drawing down their tax-deferred balance and using their standard deduction amount and lower tax brackets to decrease that tax-deferred balance. If you're in all Roth, you lose the opportunity to do all these strategies that can make you even better off in the end. And that qualified charitable distribution is a huge one, where you have this money, you can give it straight to charity and have it never taxed, where if you're giving away Roth money to charity, hopefully you still are, right? But you're losing that extra benefit you could have received, okay? So Hang on the seed or the harvest, that's the common misconception. One of the keys here is investing that tax savings. And I honestly wonder how many people are investing that tax savings versus just spending it. Because if you're spending it, you're in that middle column where you end up with the same amount either way, and it would have been way better to do a Roth. So if you have a hard time controlling your spending or even knowing how much you saved, then maybe it's better to do Roth. Well, I have a present for you. You can download this spreadsheet and calculate it for yourself, okay? To get a pretty close idea, okay, how much tax did I save by putting it in traditional? Make sure you invest that in a Roth or another account so you come out even in the end or better off depending on the tax rate. There's your example. Let's look at another misconception. And this one I've been digging into a bit. It's super interesting to me, and it's the psychological impact that tax has on people. And it goes into what's called prospect theory. And I believe a lot of people have bias because they're psychologically following prospect theory. And let's talk about how, okay? The prospect theory, Daniel Kahneman and Amos Tversky in 1979 came up with prospect theory. And what it is there are multiple core principles in prospect theory. We have loss aversion. People feel the pain of a loss more acutely than the pleasure of an equivalent gain. Okay, so I'm thinking about this, and I'm always thinking, like, why do so many people push Roth when there's so many options and what I was just talking about, right? And I think this is the key, the pain of the loss more acutely than the pleasure of an equivalent gain. People, we were going through that example and looking at the tax savings, that's a gain to people, right? I just saved this much tax. What did I mention? How many people even know how much tax they're saving? They're just saying, okay, I want to just put the max amount in my account or a certain amount. They have no idea how much tax they're saving, so they don't even know what the gain is, so they're not even comparing the gain to, oh my gosh, when I'm retired, I see comments on this all the time. People are in retirement, they're like, I'm paying so much tax, this is killing me. Where they may have saved a ton of tax over their career and just not even realized that their tax savings was much bigger than the tax they're paying a lot of times. Okay, so that's why I think people are pushing Roth so hard. It's like when you're in retirement, you don't feel that loss, right? And when you're working, do you feel the gain? And you don't even feel the loss of not getting the tax savings because you don't even know how much tax you're saving. You're just like 23,000, and maybe it's a little tight, but I don't know if people notice that loss. Super interesting stuff here, okay? Diminishing sensitivity. As the magnitude of gains or losses increases, the psychological impact diminishes, okay? So here's an example. Let's jump back to our example. We did a 50-year-old. What if we have a 22-year-old? These are my students. I'm like, get out there and start maximizing your savings, because when you're 22, you have so many years for compound interest. What if a 22-year-old applied the same strategy that the 50-year-old just did? Instead of having 1.6 million, they will have 11.2 million, $14 million, okay? That's if they did that their entire career, which I bet a lot of people could. So when we're looking at that other one, diminishing sensitivity, the tax you're paying on 11.2 million, let's say when you're 73, your required minimum distribution is, you divide it by 27.2. Assuming you're living 27.2 more years, okay? So $412,000 is your required minimum distribution, okay? Even if you're paying 30% tax on that, how bad does that hurt someone? They're paying $123,000 in tax. If you have $289,000 to live on, how are you feeling, okay? And we need to index that for inflation as well, right? So we'll take that divided by 1 plus, maybe we'll do a 3% inflation rate to, how many periods is that? 51 years. 412,000 is only actually worth 91,000 in real dollars. Okay, so when you see a big balance like that, gosh, taking out 91,000 with current inflation adjusted tax brackets, you might be in the 22% bracket. So you could have a huge amount of money. And what if you have that 11.2 million and you start using that qualified distribution strategy or other things, okay? Locking it all up in Roth, you lose the opportunity for some planning there. And does it hurt as much? Is it as painful paying 123 grand if you have 412 grand versus how much does the tax savings mean to someone who's making 150 and they can save 7 grand, okay? So it's all about perspective, okay? And that's, so, but as the numbers get bigger, maybe it hurts less, okay? And that's prospect prospect theory comes in that situation as well. And then finally, reference points. People evaluate outcomes relative to a baseline or reference point, okay? And that's where I think there's misconceptions with this decision as well, is because people don't know how much tax they're saving on the front end a lot of times, their reference point is just their account balance. So the people so in our 3 scenarios we did, comparing 1.3 million versus 1.6 million, the people with 1.6 million, their reference point is all that money's mine. Even though they've never paid tax on any of it, they're in a partnership with the government, right? They're going to have to pay over whatever the tax rate is, okay? Where the people with 1.3 million, that's their money. So they may see those reference points as the same, and so the tax, as they're paying it out in retirement, they may feel like it hurts more. That's why it's important for people to understand these concepts, because, gosh, if they're better off doing traditional, you need to know that, oh, even though I'm paying that more tax in retirement, a bigger dollar value in tax, my net worth will be greater in the end after paying that tax. So those are interesting things to consider when you're looking at this decision. And it's important to model things out so you know what you're doing, because prospect theory, the bias that you have, we all have when we want a loss aversion, right? And gains aren't as important to us as avoiding losses, okay? And the reference points, all of these things need to be considered so you can make the right decision. If you have any questions, please, comment below. Have you experienced any of these things, Roth versus traditional? Which account do you prefer and why? I know people have strong opinions on it, and so it's interesting to see what people's opinions are, or if they've experienced any of these things. Have you experienced any of these, the prospect theory or paying on the seed versus the harvest? Are you one that maybe only did 23,000 and didn't invest the earnings? It's really interesting, and this hopefully can help other people in making that decision. Do I want to do Roth or traditional? Please like and subscribe so you can spread this to more people that might find it useful, and have a good one, guys.